Hello everyone, hope you can hear me. Sorry I'm a wee bit late. If you want a copy of the slides, somebody's already them already, Uma. If you want a copy of this slide pack, of course you can have it. There's no secrets in here. This is all stuff that's been around for well over 100 years. So Uma, that's not a problem at all. So hopefully you can hear me. Let me just check that that's working. If somebody could say you could hear me, that would be good. It looks like it's working. And you can see my slides as well. So let's get going. Let me just move that down and bring my slide pointers up, and we can get going. No, don't want that. I need that and that, so I can see what I'm doing. There we go. Right. Someone's network is not good. Request to share the slides. That's not a problem. That's not a problem. We can email you them afterwards. Okay. So anybody else that wants them, please ask. Put a proper request in so we can send them to you later. Okay. So today it's all about the Dow theory, the history of it, the background of it, and is it still relevant today? Is it still relevant to other markets and other good stuff like that? I'm a big fan. Came across it many years ago. Very simple basics behind all trending, and lots of trend following traders, trend following strategies, technical analysis, technical trending strategies and concepts all can be correlated back to this early work that Charles Dow did and his colleagues in the early part of the 20th century. So fascinating stuff, very straightforward stuff. As ever, as with most good stuff, it only has a few simple rules, but follow the rules and you can move forward. Don't follow the rules, it's really up to you what happens, but the result is usually the same. So any issues with GoToWebinar, I appreciate we're all still, most of us in lockdown. Hopefully our lockdown here in Cyprus ends tomorrow. So, well, not ends officially tomorrow, but phase 1 of it comes to an end as phase 2 starts. So wherever you are in the world, take care. This pandemic has been a massive hit, both economically, socially, psychologically for everyone. So take care. I'm here to help. Okay, so any issues you have with me speaking too quickly or you don't understand what I'm saying, please send me an email to webinars@hotforex.com. That is the quickest way to get hold of me and get a response if you want the slides and stuff like that. So today it's all about Dow theory, but as ever, I need to read out our disclaimer before we get going. The material here is provided as a general marketing communication for information purposes and does not constitute independent investment research. Nothing in this communication contained or should be considered investment advice or an investment recommendation or indeed a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in Forex and CFD product is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. And finally, this communication must not be reproduced or further distributed without prior written permission or if you ask them for it. Okay, so that's not a problem. So we've got nothing to hide here. So most of this information is freely available out there, and interpreting it is, well, it's no interpretation, it's following rules. And that's what most people can't do, unfortunately, because everybody thinks they've got an ego and they're better than following rules, and have got no patience and no discipline. And that's my mantra. Those of you that have been here before, there's lots and lots of new names in here today, so welcome everyone. And I say, wherever you are in the world, take care, and if you want me to slow down, please ask, because I tend to talk too quickly, get quite excited about this sort of product, this sort of presentation. My background is in the city of London. I've been investing my own money in markets since 1997. Doesn't make me any better or any worse than anybody else. But my approach is I have probability on my side. I try and keep things as simple as possible for me, and I look at multiple time frames, which is what really today's all about as well. Higher time frames, you know, trending following approach. make sure you know what the higher time frames are doing if you're trading in a lower time frame. Are you with or against the trend? Is the big trend still going? Are you in a retrace? Or has the trend ended? Has it rolled over? Has it bent at the end? Are we going down? Are we consolidating? Are we not trending at all? So you've got to understand yourself principally first and foremost is the other thing. Because this business, trading, investing, is a psychological business because we were talking about money. Money isn't a very emotive thing. It's just a simple energy that allows you to do stuff. You know, that's all it is. View it like that and you can move forward. Get obsessed with it and it'll eat you alive. The markets go up, they go down, they go sideways. That's all they do. They're a great big money churning machine. So trending, if the trend's going up, you want to be going up. If the trend's going down, you want to be going down. If the trend's not going anywhere, you want to either be out, sitting on your hands, not doing anything, or trying to catch the top and the bottom of the channel it's moving up and down. And if you want to do that sort of thing, it's all about you. What is best for you? What time frame? What market? What plan you have? You've got to have it all written down. Watch my mindset webinar, all about improving the mindset of the trader, because this business, 90% of it is a psychological business. It's not understanding charts or understanding the news, understanding spreadsheets of companies' earnings or anything like that. Understanding, you know, the Japanese yen. It's about understanding yourself principally. So more on that in lots of webinars that we do, but it's principle. It's pins everything I do. Kathleen's having network issues. A lot of people have a network issue. We had this yesterday as well. Andrew was saying there was lots of people in her really good price analysis work necessary. So Kathleen's having problems. Okay, so today we're going to look at the Dow theory, the background and history of it, the 6 fundamental tenets, principles of what Charles Dow came up with back at the beginning of the 20th century. And is the Dow theory still relevant today? We'll look at some live charts. We'll bring us some live charts and we'll see how we can apply that to live charts. Okay. And if there's anything you want me to have a look at as well while we're doing this, we've got time, we can see if Dow theory applies to the live charts. Does it apply to Forex markets? Does it apply to commodity and or just is it equity markets? We'll see that for live today. Hopefully we can prove that with live markets. We can see the history of markets as well. So all about Charles Dow. And obviously any questions you have about this or anything else, please ask me. So Charles Dow, who was he? Why is he famous? Why do we know him today? Let's say he was born in 1851. These dates are quite significant. I know it's, people are, well, let's get to the charts, let's see what it is. 1851, he was a young man when he died relative to today's, how long we live today. 2019, 2002, he died. Why is he famous in financial markets? Well, he discovered or founded, along with some partners, the Dow Jones Company, and just as importantly, he also became founder and first editor of the Wall Street Journal, which is still obviously published today, still a very reputable financial piece of paper. Is there a PDF slide for us? Oh, I see what you're saying. I could do that, actually. I'll do that at the end. Okay, yeah, what I'll do, I'll save this as a PDF. That's what I'll do. And attach it to, I think, can I do that now while I'm talking? I don't know if I can I? Because I'm doing this. I will send it to you, Jugo. Okay, so I will certainly do that and email you afterwards. But yeah, I did that last time, didn't I? I should have done that today. But certainly we'll have it. Okay, so Charles Dow, first editor of the Wall Street Journal, wrote lots of articles within the original newspaper. And the Dow theory, he never called it Dow theory. It was after he died, it was pushed forward with 3 colleagues of his from the Wall Street Journal that created and named it in his honor, basically. So he wrote, it's based on tenets that he wrote, 255 editorials he wrote. So it's not just a quick thought scribbled on a bit of a back of an envelope. It's a considered idea and theory based around the time, and remember it was early 20th century or very late 19th century America. America was booming. America was growing very rapidly. The trains, the railroads were crossing the Midwest, we were getting to the West Coast, and all that sort of good stuff was going on. America was on a big up ramp and has been ever since, hasn't he? So he took his colleagues did later on, create these editorials and create this theory. So it was initially the principle that it became so effective in the early 20th century because it looked at two parts of markets. Before the indexes were created, the Dow Jones Index, and long before obviously anything like the NASDAQ was created or the the Standard & Poor's 500, the Dow Jones Index. So Mr. Dow and Mr. Jones created the Dow Jones Company, and the Dow Jones Industrial Average became the Dow Jones 30 or the Dow 30 we talk about today. Within that, there's lots of other indexes or averages, and the key one that he used, and we'll come to look at that in a minute, is the Dow Jones in Transportation Index, so DJTA. And one of the principles of Dow Jones theory is that these two indexes, the main one and the Transportation Index, should be following each other. If they're not in convergence and one the main one goes up and the transport goes up, but what he found was that the transport index, and that's still true today by many analysts use this, that the transport index is a leading indicator of what the main index is doing. So they should be doing the same thing. So if one's going up and one isn't, we have divergence, and it's suggesting that the market is likely to reverse. Okay, and just to bring this bang up to date, right up to date now, this link here, I don't know if it's going to work here on the internet, but this was from February from Yahoo. An article, I think it was in Investopedia. So let's see if this is going to work. It's going to work for me. Fingers crossed, everyone. But this was from February last year, this year. Yeah, there we go. It's come up. So yeah, based on, is it going to refresh? I'm going to refresh quickly. But based on Dow theory, 150 years ago, 120 years ago, and the article. Is it going to run? It's not. We try to do these things live. Oh, there we go, Investopedia. So Dow theory could signal a broad-based decline. And look at the date. Look at the date. February 21st, 2020. And indeed, what's happened since? Huge fall off. And it was all to do with the divergence between the transport index, the DJTA, which is still a traded index. So you can click it on there. We'll see what it's doing. And the main index. The main index had created these new all-time highs, but the Dow Jones failed to break out above major benchmarks, setting off a bearish divergence originally described by Dow theory more than 100 years ago. And that, just a latest exact example of how the many analysts still look at this key transportation average. Obviously, it's very different today than it was back at the beginning of the 20th century. The railroads were just developing, but transportation, these big trucks, the railways of the North America are still key to how lots of people interpret the American markets. But also, it's absolutely fundamental as well to the developing markets as well, because the one thing that a rapidly developing country like China, for instance, is a huge country. So the transportation, the airlines, the railways, the roads, the motorways, how much traffic is in all that intra-country movement, and what sort of traffic it is, it's one of those things that lots of skepticism about the official data that China has put out. But because of what we have now with satellites all over the world, countries can't really argue with where their traffic is going, how much traffic's in their cities, how much traffic is on their motorways, how many flights are taking place internally. Obviously, you don't know necessarily what's in those trucks and those airplanes that are flying around these countries, but it's a key indicator for development within the many of the emerging markets that have emerged very quickly. And it was the transportation sector within China that suggested there was going to be a massive slowdown early in this year, and also has been a key indicator of the growth of China over the last 20 or 30 years as well. And that's the same wherever you are in the world. If you're sat in a developing country, you'll so hopefully you understand what I'm trying to say. It really is, the transportation is still fundamental. So how good is the airlines? How good are the airports, the ports, the roads, the trains within your country? And that's why, again, infrastructure is such a key basis to many economies and developing economies. So it's still, but as I say, bang up to date. And this is the 20th of May, February 20. And if we just actually, let me just bring in, if we that was, this is and this is the USA 30. So here we are. Where was February the 20th? Well, there, look at that. Virtually called the top, didn't it? Now, I'm not making this up, but that was where this is the top of the market at the end of February. And that article we just looked at, the first suggestion that this is running out was this DJT area. And look what happened, a huge fall. We'll come back to this in a minute or later on, okay? So absolutely fundamental to part of the Dow theory is this idea about the Dow Jones Transportation Average, which is still relevant today. And obviously, this is just talking about stock markets, but it ripples out to other markets as well, and I'll explain that as we go through it, okay? So, and the other key thing about Mr. Dow was he was the first to really talk about markets moving in trends, and the efficiency of the market and all that sort of stuff is also assumed within Dow theory. It's obviously been questioned over the years. But Charles Dow, great man, lots of great people around at that time, the beginning of the 20th century, some great traders, some great investors, some great industrialists, Rockefeller and all the, Jesse Livermore and all the other now legendary traders around at this time. Mr. Morgan, JP Morgan was, all these things were just developing at the beginning of the 20th century. So a very boom area, and Charles Dow was fundamental to the financial markets of America in the late part of the 19th century and the early part of the 20th century. So it's 100 and plus years old, 120, 30, 50 years old, been around for a while. So the 6 fundamentals that we need to understand that created Dow theory, and this now underscores a lot of technical analysis. A lot of the indicators you might hear today are certainly the trending ones, and analysis and indicators that have created since this theory sit within Dow theory as well. So 6 key fundamentals. We'll go through all of them individually. One was that markets move in 3 phases, 3 movements. Markets have 3 movements, obviously big, middle, small. And then the trends can either be up or down, and within the trends there tend to be 3 phases again as well. The other key thing was it was very much, although we're talking about technical analysis as well, the principle was that the price discounts everything. The market discounts all the noise that's going on. So the noise of news today, we bring it up to date today. So the noise of a Trump tweet is discounted by the price of whatever you're trading, okay? So earnings numbers, crop reports, a chief executive being sacked or being appointed, all that sort of news is discounted by the price. The price is everything. So all the, we all focus every month on the non-farm payroll data, very a key fundamental piece of data, and we get massive volatility as the numbers come out typically, don't we? It's a very big move that for NFP. But Dow theory would say, well, that's just noise of the day, noise of that 30 minutes, noise of that 1 hour. And the price is what the price is. The price closes is the key price, and that's the other key thing. The closing price is king. So remember, this is based on stock markets at the beginning of the 20th century. So the closing price, the end of the day price, was the key one that he used, and that was the key thing that was held dear, very, very dear to Charles Dow in these documents that he, these editorials that he wrote. Volume has to go with the trend, okay? So if things going up, volume should be going up. If things are going down, volume should be going up as well. You know, they've got to be going with the trend. There's no point in very low volume and prices moving down very quickly. That's suggesting some sort of divergence, some sort of, well, there's no volume why are the prices falling if there's not many people participating? Well, it's just somebody could be getting manipulated. It could be one particular seller, somebody trying to move the price down deliberately because they want to accumulate more stuff at a lower price, and that's what we'll look at in a minute when we look at the phases and the movements of the market. One thing that we've just talked about are actually these markets confirming each other. So the transport sector needed to confirm the main sector, and it's not just the transport sector. You could use other markets confirming it. Now, obviously, people say, well, that's not relevant if I'm trading the Forex market, or if I'm trading the gold market. What other markets? Well, you can still use other markets to confirm each other, to confirm the movement. Okay, so if there's divergence within certain things, so the principle number 5 was that markets needed to confirm each other and back each other. And finally, my favorite of all, to be honest, the trend persists until proven otherwise, and that's the issue. That really is the issue. Obviously, the big problem is when there's a trend following traders, or when is the trend started? When is the trend over? Well, we don't know it's over till it's over. I keep saying it. I say this time and time again. I know it sounds very coy, but that's true. And you don't know the trend started till it has started by its very nature. We haven't broken out unless we've broken out of an area. The gold market, for instance, was a classic last week. We were looking at, the key resistance was this 1725 level. We suddenly burst through it on Thursday. We followed through on Friday. We followed through again on Monday. We rallied very, very aggressively. We gave a lot of it up, but now we've bounced back from it. So we'll have a look at that as well as a great example of, trends continuing. The longer term trend, a little shorter retrace, and then we move back up again. And that's, you see that time and time and time again. Phases within phases, waves within waves, big waves, little waves, smaller waves. Big move. Know what your trends are. Know what your time frame are. Trade the time frame that fits your personality. Be aware of what's going on in the higher time frame. Be aware of what's going on in the lower time frame. So trends persist until we prove otherwise. So let's go through these in a bit more detail. So markets have 3 movements. So we have the main, the primary, the major. It's called all sorts of all 3 things. You see it written down in the literature. The trend, it can either be up or down. So we've either got a bullish trend or a bearish trend. But the main primary trend can typically, a minimum of months, but typically years and years and years. You can see that people talk about the bullish trend in the equity market since the last big financial crash. That's 11, 12 years ago. And that bullish trend has gone on until we turned bearish. Earlier in the year, we crashed through down. The secondary movement can last anything from, again, days to months. And it can happen, all these waves within waves can happen at the same time as well. They can all happen at the same time. So they can have, a secondary retrace of the main trend, but we can have short swings still very, very positive, but still going down for 3 months. But the upper trend still maintains its dominance. Okay, so typically the secondary or the medium reaction, typically days, weeks, months, typically untypically. So we go against the main trend for up to 3 months, typically retracing a quarter, sometimes 3/4 of the whole move. So again, this comes into this idea of Fibonacci as well. What happened, remember, centuries before Dow Theory, but it's sort of fitting together there, this main trend. And then the short term, or the daily, day-to-day noise, as he called it, oops, straight there. This can be minutes, hours, months, or even more. Okay, so it's all about waves, and again, it comes with wave analysis theory as well. All comes into this. This is something that was written much after Dow put his simple trend following trend analysis theories together as well. So Gann analysis came after this as well, and Elliott wave analysis came into this. And you see how Elliott wave analysis fits into these waves and waves, and this main trend, reaction, retrace all the time as well. So 3 movements within the trends. We have 3 phases. Okay, and this is one thing that that Dow put together and was a big fan of. There's the accumulation phase, the participation phase, and the distribution phase. So the accumulation phase is those in the know, particularly in stocks. So you don't get this with, you don't have this problem with when you're trading Forex market. When the accumulation phase, remember in the early 20th century, it was a small, it was the network, it was a very small network, New York, and Chicago trading houses. There was the in players, there was the known people, those in the know. That's still around to an extent now, the key players in banks now and all the rest of it. But this was the accumulation phase down here. If we're moving up, the accumulation phase takes at the beginning, the A phase. If we're in a downtrend, the accumulation phase takes at the end, as they've sold off and they're collecting for the next move up. So the accumulation phase, those in the know, they absorb stock, or they would absorb volume without moving the market particularly. So you get this sort of typical sort of range bound movement. So that's again where we have these markets that are moving in ranges for long periods of time before the trends come in. Remember, markets can range, 70% of the time. They're only trending 30% of the time. So but trends then can go on and on, as we've just seen. The second phase, the participation phase, is when the general public get to hear about it. The news gets out, everybody starts gossiping in the pubs and the clubs and the bars, and have you heard about this latest sexy thing? And it gets, the trend starts being identified. The trend followers, people like me will start seeing it and, oh, look, that's moving up, let's jump on, we're in the trend. So we're breaking out. So this is this sort of move here. So we've moved up, and often you always hear about this excess where it just keeps going and going and going, and everybody gets in, and the worry about not getting in, the fear of missing out, they're getting late, and everybody's running up, and we get overbought, just a bit like we got here, you could argue. Everybody getting in up. So we consolidated, bit of a retrace, big secondary retrace, but the trend was still going up, wasn't it? It looked like we were going to go down, but this is December. Remember December 2018 on the stock markets, where we had this big, we've broken that uptrend here, sell up, but we bounced back really, really quickly, and so the upper trend came back into phase. So although we'd moved down here quite significantly, this big uptrend was still in place. We had a down move here, another secondary one here, but this trend, the higher trend, was in place. Obviously, the lower noise was going sideways here. Then we went back up. Then we went down, and then we've been up and down, up and down. Big final move up here, and then we did finally break through this big, trend that had been going on for years and years. And we did move down. It was a big shakeout, very, very suddenly. But the suddenness of the shakeout was replaced with this, with the suddenness of the retrace. And this is because it's a particular issue, and that's what's going on now. Where are we going from here? Okay, so we'll come back to that in a minute as well. Okay, so that's the participation. As the general public get in, the trend moves up, often to a, so excuse me, and then at the end of the trend, or towards the end, as the trend is topping out, again, like we said, we've got this distribution where the players, the early guys that got into the market, are selling. Okay, later participants start panicking sometimes as we got out, and that's why the distribution can go down, or the trend can end very violently. Okay, most people want to try and get most of this trend, or most of this trend down here. As you can see, it can go on for a while. As you can see here with this downtrend on this particular example here, the trend is down, but we moved all the way down there, and then we retraced all the way there. So that was even more than 60%, wasn't it? But it was still lower. That high there was still lower than our previous high, which is still lower than our previous high here. So the trend was still just about in place, even though we'd gone down, because these lows were lower, consistent. The 3 lows were consistently lower. These highs were lower. So there we got the 2 rules in place, and there we go, the low. So we got consistent lows, consistent lower highs, and so the trend is in place. Just like the uptrend, we got higher highs here, sorry, higher highs here and higher lows as well. So the trend is going up, and that's one of the key principles of Dow theory as well, to create the trend. Consistent, consecutive higher highs, consistent, consecutive higher lows going up and going down with consecutive lower highs and consecutive lower lows as the trend unwinds. Okay, so the phases, the accumulation at the top here, people participate, and then we distribute at the bottom. So trend, so we have consolidation, trend, consolidation, trend, consolidation, trend continues, and then distribution at the top. So accumulation, participation in the trend, and then distribution at the top. That's the three phases of a trend, whether it's going up or going down. As I said at the beginning, number 3, markets discount everything. The price is king. All news is absorbed quickly and incorporated. Markets are efficient. That's one of the principles of Dow theory. It's a bit of a question mark over the efficiency of markets. So it's better, Dow argued, to study the price movement, price action that Andrew was talking about yesterday, than be too absorbed with news or balance sheets or earnings or, you know, reports of future sales or new, as I say, new chairman, new CEO, management board. It's all about the price, all about the price. It's all about the chart. So look at the chart, look at price action. It's the, have we got a trend? Have we not got a trend? What's the higher trend? What's the secondary trend? What's the tertiary trend? You know, waves within waves. Where are we? You know, and within your time frame as well. You can still get these movements. These are over years here, as you can see down here, because we got these big rules, but you know, you can still get them compressed into smaller time frames as well. Okay, so there's a note I was going to bring up as well. What's on with it? Did I write it down? Oh, doesn't matter, we'll come back to it in a minute. So 6, 3, markets discount everything. 4 is volume. We talked about this before. Volume, the trend should be supported by trading volume. So in bull markets, if we're going up, volume should be increasing as the price rises. And again, this can be applied to other markets as well, not just stock markets. So volumes should be positive if bull markets are going. If the price rises and continues to move up, if we're going to retrace or fall in this second phase, you would expect volumes to shrink somewhat, because we still want to be moving up. You know, we want to be buying. The buys are going up, so we want the volumes to be rising in bull markets and bear markets for that matter. But in bear markets, we want volume to increase as the price falls, not price going up. And volumes would increase as it retraced back up. So if you're with the trend, whatever your identified trend, you want to see volumes rising. If you go against the trend, you don't be too surprised if volumes fall. You'd like to see volumes fall as well. If you get rising volumes going against the trend, that might be an indicator that the trend is coming to an end as well. So volume is key, or can be key. And we'll look at that if we add our volume indicator to our charts as well in a minute. Okay, actually, let's do that now, shall we? So this very simple chart we've got here. We've got our longer term trend here. This is the weekly on the Dow. We identified the top. So let's just insert. Actually, let's just add volume on here. I think volumes could show volumes very simply. Okay, so see if this stacks up with what's going on. Okay, so let's zoom in a wee bit. So we got rising, we got nothing, you know, volumes trending along fairly steadily as the trend continues. We've got a big spike here. See what we got here? We got this big spike here as the volume came down. So that was perhaps a first suggestion that this initial run had gone too far and we were moving down. So as we move down through here, the volumes had this high here, continue to fall, but significantly. See how much more significantly higher they are here in February 2018 than they were in 2017. So these big candles, this is bar chart, but it doesn't really matter. It's just how it's presented here. The big bars here, there's high volatility. large candle weeks is supported by high volume. So the volumes have increased significantly. So we moved down, prices moved down as volumes moved down, which is interesting, wasn't it? So our next leg up we had here, our volumes increased significantly as well. So we moved up, we retraced, volumes retraced as we went down, but went down quite significantly. And then again, volumes started to increase again here and here as we started to move back up again. And then we had this huge volumes here as we sold off. So massive amount of volume compared to where we were back in 2017 as this huge move took place. So lots and lots of volume in the market in the last few weeks of March and April that we've just seen for ourselves, haven't we? So volume is key. There's other way, obviously there's other more sophisticated ways of adding volume than just a simple volume chart. You can look at buyers and sellers. We can have on balance volume is one of my a favorite indicator of mine. I just insert on balance volume on here. Okay, so you get a bit more of a trending line with the OBV. So here you can see the volume on balance volume is continuous. So this gives you a bit more in line with the trend, consolidating as we've gone down, but volume's gone down, so that's suggesting something, but still elevated again as we've moved up here. We've moved down here, and that's in line, and then we moved back up, and we got higher again. We got a bit over the top and then down and down, but we're still elevated compared to where we were back in 2017. And big price movement here, but see how the on balance volume still remains very high because we've got a huge elevated amount of volume, a significant volume creating this huge move. So this is again in correlating with each other as well. Okay, so let's just bring that out. So that's volume. Volume is key and a key tenet of the Dow theory, particularly on markets. This 5 theory we talked right at the beginning, the fact that markets must confirm each other, and this is significant. As I said at the beginning, the expansion of the United States in the late 19th century, the beginning of the 20th century was key. So the transportation index, obviously principally the railroads and the early cars, were absolutely key, and they needed to correlate with one another. A breakdown in that correlation could suggest a breakdown in the equity markets itself. Now, just as we saw at the beginning, bringing it right up to date, that's exactly what happened as we got to the top of the market here, which looked like, obviously at this point we could say, oh, well, it's just going to move down like it's done previously, like it did in February in 2018, like it did during the final quarter of 2018, went all the way down here for heaven's sake in December 2018, but we bounced back really quickly. Yeah, we had a similar sort of divergence at these points. I remember looking at them, but you know, the sell-off was very rapid. That movement here, we can see that. I can't see the movement here within like 3 weeks was much more volatile than the 3-week movement here, or anything we had even here at this point, or even here. Huge issue of the pandemic hitting equities and lots of other things as well. So that was an unprecedented situation, and we've obviously we've bounced back quite well from this low, but you know, that low is under 2,000, wasn't it? Or under 20,000, the Dow Jones went very significantly. So here we are back to 24,500, and looks like we're consolidating again at this range, just like we did here. We rallied up here. We sort of rallied up, but consolidated for a few weeks before the last, and then we went down, and so generally up. So where we go from here, we shall see. That's the whole point of analysis. But big volumes following the pandemic. So transportation index, key confirmation of each area. And finally, as I've said before, and many traders have taken this on since Mr. Dow at the beginning of the 20th century. The trend persists until proved otherwise, and that's the thing. You know, trends continue and seem to continue until the reversal has been signaled. So, you know, and that we got lots of technical analysis that helps with that. You know, the Fibonacci theory, the Fibonacci retracement. We can only use Fibonacci retracements once the trend is ended. You know, Gann analysis as well. The 5-wave analysis that puts together many cycles within cycles, circles within circles of moving up. Trend reversals. Richard Dennis and the turtle trade is very much trend following style, you know, following trends until they were proven otherwise. Richard Donchian, the Donchian channels, very much a trend following guru, following Dow's original theories. And again, you know, the Donchian channels, very, very key. The father of trend analysis, trend following analysis. And probably the most famous quote of all from Ed Sikota, the trend is your friend until the bend at the end. I think it's something like that, he said. But, you know, the trend is the end until the bend at the end. You know, it keeps going until it stops going. You know, the issue is when is it ended? But, you know, if you get a bit of that trend, you don't need to catch all of it. You know, catching the main of it is what trend following traders do. You know, so you can you know, it can be positive in bull, bear, and even these very, very surprising markets as well. Trend following, you know, follow the rules and apply the rules. So 6 key tenets of Dow theory, relatively simple and easy to apply. And the rules, so, you know, let's just run through these again here. So primary trend, longest lasting, typically over a year. Expects the movements in stocks as well as other assets as well, can be applied to lots of other assets. We'll bring up some other assets if what are those analyses? I have no clue. I'm not sure what you mean. What are you talking about? Almost just I don't understand what your question is. What don't you have a clue of? Uma, what are those analyses? I have no clue. You talking about the? Are you talking about the charts? Prashad, I don't understand what you're. Can you explain a bit more? I'm not sure what you're. Let's just run through these the three trends. Okay, so the primary trend, typically, you know, generally lasts 1 to 3 years. But as we just seen with the stock markets, the last slide. You talking about this one? This one. Or the last slide. What are the? Yes, right. These are well. These are. Oops. These are other. Oh, come on. These are other. These are. I'm using these examples here. These are trend following either gurus like Richard Dennis and Richard Donchian and Ed Sikota, or trend following techniques like Fibonacci theory, Gann analysis, and multiple wave. They're all different technical analysis ways of analyzing trends, basically. And you can spend a whole whole courses, whole days studying all these different types of analysis. I'm just using it as an example of the 6th tenet of Dow theory back 120 years ago was a trend persists until it's proven otherwise, and that is absolutely true, and that's still as true today as it ever was. But we again look at our past webinars. We got webinars on all of these different techniques. Okay. Yes, there's a whole host of Fibonacci theory. The one that's talked about the most and the simplest to apply is the retracement techniques, but there's lots and lots of other parts of Fibonacci as well, like fans and bars and consolidations, all that sort of stuff. But yes, all part of trend analysis basically is my point of this. Yes, and all these characters here. I could have written loads. I just ran out of space on the slide. Lots of other things about trend following analysis and trending indicators as well on that one. Okay, so that's answered your question. So let's just go back to 3 main parts of the trend. So big trend lasts years, typically a year. So if you're looking for a primary trend, get your chart, go back at least a year. Is there a trend? Okay. there we go. It remains in effect until there's confirmed reversal. So let's just use that as an example then. So the primary trend, it's important to identify a directionist trend and trade with it until evidence of a reversal is clear. So that's what the the stock markets have given us, isn't it? So even here, so here we've got, this is the weekly chart. We've gone all the way back to 2012, 2015, and that trend has been very much. So if we zoom in and just go back a year, where are we? April. There we go. April. The trend, even here, the trend was still up, wasn't it? Until it wasn't. So that's our up line, and now it's clearly, a big break of it. We went back to the trend line, but we've broken it. So that trend over? Well, if we zoom back in, remember this is going back years and years and years, 2011 even. So we need to get back up here if this primary trend hasn't broken. Okay, so the secondary trend has broken that significantly. Like we were down there, we much shorter retrace. This one has been incredibly violent. It went from a bull market to a bear market because we lost more than 20% of this high to low. So we went from 29,500 all the way down here to 18,100. So we lost 7,000 or 29,000. So it's a huge percentage loss, but we've retraced most of that. So again, if we use just some simple retracement theory, again, we're talking about, so we lost all of that 100% fall, but here we are, we need to get back. This is applying Fibonacci theory now to the markets. We need to get back to 25,300 to retrace that key level, and at the moment we haven't got that. So that's why markets were very much, our participants are very much, have we retraced enough? We haven't got, we've got to and retrace 50% of the big sell-off, but where do we go from here? And that's what the next big theory is saying. So again, applying different wave analysis or other different technical techniques along with your Dow theory. Well, it's a wait and see phase because we're back over this, but obviously last week we were, a few weeks we've been under the 50% on this particular, I'm just talking about using this chart as an example. Okay, so that's where we are now. The primary trend looks like it may have often. Let's drill down. Next one, primary, the secondary trend, intermediate trend lasting 3 weeks to 3 months. So are we still in that? Well, yes, we are, because this was February. Here we are, March, April, May. We're coming to the end of May. Interesting. The correction to the primary trend, is it just a correction to this big move? This big move up, we've corrected, but we've corrected hugely, 60% of that, we've moved a huge move. How much of that uptrend? Well, if we zoom in again, it's in the whole scheme of things of the up move, that's still a significant retrace, isn't it, of the big up move. So, but even so, this goes back again. This is only going back to 2011 here. This move started in 2009. I can't show that, unfortunately. We're still within the requirements, the rules of the Dow Theory. We haven't retraced more than 60% of that huge up move. Okay, so here, so we're still in secondary phase. Carabal, I'll just get to your question in a minute. Okay, let me just run through this up thing. So it's a correction to the primary trend. Upward primary trend will compose of a secondary downward movement like we've just seen, and a primary downtrend, secondary trend will upward move. Traders would use this to confirm the validity of the correction within a primary trend if the short-term highs fail to create successively higher highs. So this is, again, part of Dow theory. You've got to have successive higher highs like we just talked about. Where's my chart gone? So let's zoom this up again. So if I zoom, what do I want to do? I want to zoom in a bit, don't I? Zoom up. There we are. Just move that. So here we got, that was a retrace. The highs were getting lower, the lows were getting lower, and then we started getting highs. We got successive highs as we went up, and then lows, lows, lowers, lows, and then we got successive highs going up again. So the trend was back on. Here we got highs getting lower, and here as we've retraced, let me zoom that up again, we've sort of got, it's very volatile, but we still got the highs were getting higher, then we've retraced again, haven't we? So again, looking at using Dow analysis, second wave analysis for this, we need to get back initially over this 25,000 level. Then Fibonacci would say, well, you need to get a bit higher than that. If you're going to retrace, we need to get to 25,200 level. But the lows, certainly, this is why there's a bit of sentiment, positive sentiment kicking around. The lows have certainly got higher from this hiatus at the end of March. The lows are definitely getting higher, aren't they? So that low is higher than that, is lower than that low, and it's that low is lower than that low. So the lows are getting higher. We just seem to have staggered into a consolidation phase, but that can go on, as it said, for weeks and months potentially. So phase 2 is where we are. Not primary, sorry, next one, this one. So we were lasting potentially months. So there's a conflict within the secondary trend. The noise, the minor trend, typically less than 3 weeks, is associated movements in the secondary intermediate phase, goes against the direction of the secondary trend. Due to its short-term nature and long-term focus of the Dow Theory, this trend is not a major focus of the Dow followers. Traders will get distracted by short-term volatility and lose the sight of the bigger picture. So that's one of the noises of the markets, one of the things the Dow theorists discounted. So where's my chart gone? Oops, I was going to come on to that in a minute. Where's my chart gone? My chart again, so just use the same one again. So short-term noise. Well, what is going on short-term noise? Well, this is the weekly chart. So we've gone up quite well, and then we rallied there, and then last 3 weeks we went down, and the last 2 weeks we've gone up. So short-term noise. We drill down again to a lower time frame. You can see what's this? This is daily from this is our fall. So the daily is a bit more positive, isn't it? The highs, the lows are getting higher, and the highs, you can see how they're flattened out. So we've got even more of an exaggeration flattening out. So we're just, is this a consolidation phase, which is what it looks like, doesn't it, here down at this daily time frame? But this, remember, is our primary trend still. We need to get back up here, this 27,000 area. So is that still in place? Well, who knows? Possibly, but we've certainly shook out. We've replaced. Volumes are sort of starting to shrink again, but it's not very clear, is it? We're in this daily time frame. We're in sort of a consolidating phase, aren't we? We're above that 38, but can't get over the 61. It's a bit of a drag there, isn't it? But we got some support for the last few weeks over 50. Well, sort of, but it's not. It's there's as much action above this 50 Fibonacci as there is below it, isn't there? No, that was looking quite positive to that point, and then we went lower again here as we came into. See what's happened there? We were looking up to this point, looking okay, but those couple of days there pulled us down the beginning of May, and then we've recovered again. So since that spike down, we've recovered quite well, but we can't again get back up over there. So the big up day Monday and Tuesday, yesterday and Monday, we're back to the top. So we're bashing the top, or trying to break through the top currently, but also more recently we've actually tested the floor. So that tested the floor and rejected it. So again, that's why that buys and the sentiment may have picked up. Okay, so that's the daily one of what we're talking about. Right, Carabel, let me get to your question. How would one apply the Dow theory in analysing the difference between the market and the economy, given the fact that the global economy is currently uncertain, but the markets are up? What does this tell us about the application of Dow theory? Great question. The other thing, Carabel, you need to bear in mind as well, there's the breakdown as well, the big gulf between the financial markets and the normal day-to-day, your existence, my existence, the normal, going to the shops and buying stuff that you need. There's a big disparity. Remember, financial markets, particularly equity markets, are forward-looking. They're at least looking, forward to the next year, 18 months ahead. They're looking at how companies might be doing, all that sort of stuff. But Dow Theory would say, well, you ignore all of that, don't you? It's in the price. It's in the price. So here is suggesting, applying your Dow Theory, is that we're not sure what's going to go on. It was bad, but we've recovered a bit. But where are we going now? We had a consolidation for a few. This is only days, isn't it now? So actually, let's bring up to the weekly. It's a bit more relevant. So we had a big sell-off for 5 or 6 weeks, and now we're consolidating for the last 5 or 6 weeks. So, but last week, interestingly, was lower than the previous few weeks, wasn't it? 1, 2, 3, 4, 5 new 6-week low. We spiked last week, but this week we're trying to move up, but we still want to, you'd like to see that break above there if that movement up is going to go forward. Okay. So yeah, Dow Theory is very much based on, was based when it was put together on equity markets in particular, but as I just showed you, it's still, you can still use those to take a big step back and don't get too drawn into the short-term noise that's going on. So to answer your question, Caribou, it is, it can be, if it's a general doom and gloom around the economy, but what are the markets doing? Well, the markets still look relatively positive, and again, just adding some fundamentals, which Dow Theory doesn't, because it says it's all in the price. The fundamentals are relatively supportive of that because, fundamentally the key US market was still fundamentally quite strong before we went in to this unheard of medical pandemic. Prashad, you asked me another really confusing question, or it's confused me. It's probably just me. Where to keep the zero and why? Please explain. Oh, I don't understand, Prashad, my friends. Where to keep the zero and why? I don't understand that at all. Well, I don't know what you talk. What you're referring to, my friend. On the previous slides or these slides, I don't know. So they're the 3 principles. So they're the 6 tenets of Dow Theory, the phases and the waves, and you can see this in lots of other, as I said, lots of other analysis that's come since. And sorry, let me just go back to this. So these 6 fundamentals, these 6 tenets of Dow Theory are still applicable today, okay, as particularly as trend following analysis. And again, any other technical analysis, some of it falls out from this as well, like the very popular Elliott wave analysis, for instance, that talks about waves and the 5 waves and the retracement waves, the main leg. And again, it's the same theory here within, or same sort of principle, not the same theory, but same principle within Dow Theory itself about markets moving up. But as I say, it can be applied. It's not just equity markets. So it's not really relevant, that slide. So let's just instead of just me just using I know I've run over time, so instead of just using equity markets, let's just bring up another, I know, somebody suggest a market to me, and we'll see if we can apply our wave analysis, our Dow theories to a market. Somebody give me a market that isn't an equity market, because that's what it was principle. Give me whether it's a Forex or a commodity, whatever it is, doesn't really matter. US oil, Caribou, right, US oil. Okay, so let's just open a new chart and see how if we can apply the theory we've just looked at to the oil market. So US oil. So there we go. That's how it comes up. So let's go up to the weekly, because remember, we want to look at the primary. Actually, lots of people have voted for the NASDAQ. Caribou, you were first. Well, actually, that's right. There's three here. I'm not going to look at them. Somebody's asked for oil. Somebody's asked for gold, and so a lot of you are asking for the NASDAQ 100. So let's do it for. Well, I said not equities, because we've done it for the equity market. It works very well with the equity markets, guys. So we'll have a look at oil, and we'll have a look at gold. Okay. So let's go up to the weekly. So this is the weekly market for the US oil. Going back to 2002. So let's just zoom in a bit so we can see a bit So Dow Theory say, well, what about the last year? So let's just zoom in, or last few years. So where's the trend? Well, let's have a look. What can we see? Well, that was going up, wasn't it? So again, that was going up. It looked like we rolled over, and this one was sort of coming down, wasn't it? So we were sort of in a down channel. Primary trend retrace. Zoom in a bit. And that was a retrace of this big leg down, wasn't it? You could argue. So going back all this time. Okay. So that was down. That was a retracing that, but then we went down and we've gone down again. So that's blown that uptrend that was going on here in the 2000s. Okay. So that big uptrend that took us all the way to $100 plus has blown. We've retraced that. So that then down. And now a very, very violent shakeout. So if we zoom in again, let me zoom in. Can I zoom? No, zoom out. So here under $30 a barrel, you know, we went to under $10, didn't we? Incredibly low. So the you know, history again was telling us. We zoom in. History was telling us that it got completely oversold, and was this different this time? Victoria, of course you can have PDF of this webinar. Of course you can. Of course you can. So it got really, really mega extreme. So let's just zoom in and let's have a look at the rules. Well, the rules, you know, on Dow Theory let's take us back 2 or 3 years. So this takes us back a bit longer than that, doesn't it? That's 15. Let's zoom in a wee bit more. So this takes us back 2 or 3 years. So here we'd had a bit of a change. We'd sort of, the trend has been moving down, hasn't it? So the main trend here, going back to the highs here from October 2018 at $76, has been to the downside, hasn't it? So we've gone down, went down quite aggressively to start off with. We retraced, secondary retrace, but not as a big move down. Then we continued our leg. We continued our leg down, flatter, and then we moved down very aggressively, haven't we? Since then. So that trend, this is the weekly. So the higher trend. Let's zoom in this now. See if I can do that. No, it's not. So that downtrend persists in the oil market, doesn't it? So we've got down, retrace, down, up, big sell-off. But now you'd expect that to come back up. But you know, these channels could extend. So the trend remains to the downside for these this oil market, one would argue. Okay. However, you could also argue, you know, moving down, big, unprecedented, you know, but the price is everything. Again, forget about the news, forget about what's caused it. This once in a lifetime pandemic, once in 100 years. We went all the way down here, didn't we? You know, under $5, $10, $20, $30. So now the bounce back, this retrace, you know, from the last, this $65 we were up because of the Iranians and the Americans fighting with one another. So the latest leg, this movement down from the top here at the beginning of the year to this very, very violent, let me change that to yellow so you can see it. Move needs to get back, you know, again, Fibonacci technique will tell us, well, it needs to retrace back to $43 if it's going to recruit this big, get back into this level up here, 50 or whatever, later in the year. So they're the levels, you know, $36 is the 50% retracement of this huge move down, and $43 is 61%. So that downtrend remains in place. We're still, you know, it's a weak recovery, and it's still historically very, very weak. The major trend is still down here. Our secondary trend and now this violent one, you know, have we broken it? You could argue, well, perhaps we're back over $30 has broken that secondary trend, so we may have a bit of a further follow through rally to come for the oil market. Volumes again, let's put the volumes on. Insert, actually just do it on a simple chart. So you see massive volumes here. You can see how they've, they've coincided with this massive sell-off, huge volumes here, very general volumes as we've, nothing there. Volumes increase as we got to this floor and we moved up. Volumes, big volumes as we've sold off. Interestingly, again, if we insert another indicator, the unbalanced volume indicator, you'll see how that just collapsed as the price collapsed as well, but has bounced up and is moving up back over zero. Very rarely goes under zero on unbalanced volume indicator. Completely oversold, and here we are moving up. So the volumes are following through this movement up. It doesn't actually suggest that there, does it? But some price strength in the oil market in those higher time frames. So if we drill down into the daily time frames, this is our downtrend weekly line we've sort of breached in the last couple of weeks as we've got over the key $25 level here through here, and now we've breached $30 and we need to get back to that $36. And then there's the gap here we had as the news broke. So the breach of this 50 fib, we should very potentially quite quickly run to the 61 fib as well. So lots of market participants looking at $36 and $43 going forward for the oil market. Okay, somebody asked about gold as well. So let's just do the same thing. Let's just do the same thing, a completely new chart for the gold market, and just build up the story. Gold. So let's do the weekly again. So uptrend here to 2011, downtrend from 2011 to 2015, and then a general uptrend from these lows of 2015. So that's 5 years in. That's two. Where are we going? 2016, 28. So our major trend here, if we go back, the 1 year, 3 year trend, the trend is up, isn't it? The trend, the uptrend, oops, it's too far. This is weekly going back to let's zoom in a bit. So there we go, we're consolidating. So the trend is very much sort of through here, isn't it? Up, an uptrend. We've got higher. We're following the Dow rules. We've got higher highs going up here. We retraced, and we got higher highs again. So we got a high there, high there, high there, little retrace, and new high, retrace, new high, and it's getting very aggressive. So here, the top of the channel is is up here somewhere, isn't it? Where we go, we're going up, and so that gold market continues to accrue from these lows of the same time we looked at in the equity markets from November 2018. So last 2 years we continue to accrue, and so the lows have got higher, the highs have got higher, and here we are today at 1715, so moving up. So that remains the longer primary. Whoops, let's zoom that in. Zoom that in is what I want to do. There we go. The trend is up. We've got our secondary retraces here. So we've got a retrace there, obviously. And again, these are easy to see afterwards. A retrace there. Big hiatus here, got early in the year because of the whoops. That was the volatility of this unheard of pandemic, but then we've retraced very, see how V-shaped that is, and we've gone back up again as well. So continue to push higher, and again from this big move down, if we zoom in again here on the weekly, what is that? You can see the last 6 weeks, these lows again have got higher, and the highs have got higher. High, and then we just pushed in, pushing a new high this week here at 16 64.63, wasn't it? 17.64.63 in the week, wasn't it? Okay, so that continues to move higher from here. So again, wave analysis helping you with the gold market. It continues to move, and just going back, well, where are we now? Where do we go from here? Well, if we look to the left, we're back to the summer of 2012, or September 2012. This is on the weekly chart. So through there at that key 1785 level to 1800. It's the next big round number, but we didn't get there those weeks. So you can see, 1780 for 3 weeks in the summer of 2012, and then we go back further to here. This takes us to the summer of 2011 when we were up here, and then the all-time high was over 1900 here, on the recent all-time high of 1900 here from April 2011, 9 years ago. So these, they're the next levels to be looking at for this rampant gold market. But some of the technical analysts might say we're a bit overbought. Okay, so that's oil and gold, just building up the story, seeing the waves going back. The time frames we're supposed to go back to. So this, again, let's just recap. So we went back 2 years here at the beginning of the trend because we've been down. We've seen our secondary retraces, but the upper primary trend is still going. The noise of all this big sell-off has been sort of discounted, and off we go again, breaking out. Obviously at this point here, it looked like we were still in consolidation, weren't we? And indeed we were. I remember it well last summer, and then we broke out really aggressively here, didn't we, at 1330? Then we broke 1400, and that was just a right old rock and roll way with the gold market. Okay, so trend following, Dow analysis. Any further questions, guys? I've run over quite significantly. Well, not significantly, but I started 5 minutes late, didn't I? So I'm about 10 minutes too long. So thank you for hanging around. Any further questions, guys? Any other markets you want to have a look at? I'll tell you what, let's are you still here? Let's have a look at the NASDAQ. Let's do the same thing for the NASDAQ, okay? Profile, index charts. Oops. Let's find a new one file. There's a new chart, wasn't it? Let's do the USA 100. So it'll be a similar story to what we've just, let's go to the weekly. Let's use that and zoom in. Again. So again, we got these all-time high. This is interesting, the NASDAQ. It's we got this all-time high up here at 725 from February, again, as the big sell-off came. But the primary trend, again, going back, just up there, wasn't it? It was sort of going, trending up. So that's still in place. And interestingly, the NASDAQ is back over that primary trend. So the sell-offs, as we've gone up, relatively minor. That one broke it. And again, this is the December, the recent low, the December 2018 low. But again, we retraced little trace, big final rally, and then sell off very significantly. Again, Dow Theory just says, well, it doesn't matter why it sold off, but it has sold off. But the aggression of the sell-off was very, very steep, and moved down. And again, with the you can see how we've bounced back up quite aggressively as well. So this V-shape fall and rise. If we zoom in now, let's move that. Delete that trend line and put it at the bottom. Best way. Okay. So again, we fell very aggressively, appear to have moved up quite aggressively as well, back over this main uptrend line, and within just a few percent now, 4 or 5% of the all-time high. So NASDAQ remains very well bid. The weekly chart, you can see the last 5 or 6 weeks, the highs have got higher, the lows have got higher, a bit of a retrace there. But again, if you drill down to the daily time frame, nicely higher highs on the daily, lower highs on the daily as well. So the trend very much, as we've broken over this primary trend line in the beginning of April, has continued to rack higher for the Nasdaq. So again, Dow Theory coming to the USA or the Nasdaq 100 or USA 100. So that's all, guys. Thank you for your time. Any final questions before I go? Still quite a lot of you left here. As I say, trading really is, you know, an emotional business, mental business. But you know, theories help you stay in business. Tomorrow, ironically, let's come tomorrow and look at, you know, how Otto talks about trading the news. So today, Dow Theory says we discount the news; it's all in the price. See what Otto has to say about the news tomorrow. Live analysis with Andrea on the 26th. The best trading book, one of the most fundamental trading books ever written, also back at the beginning of the 20th century, The Reminiscences of a Stock Operator. Join me on the 27th and win a copy of the book if you come to the webinar. The recording, Ridwan, will be available as I finish. I'll put that up. Right, some questions are coming here. It's difficult. Nadian's saying, please show the slide after the primary trend. Right, let me go back. Certainly. I asked and you asked after the primary trend. This one, secondary trend. So this is the retrace. Okay, so primary trend is the main one we showed. So the retrace, typically 3 weeks, 3 months. So again, applying it to the Nasdaq, applying it to the equity markets now. The top was February, and we've shook out. You know, we sold off very, very aggressively, but we sold off for March, April, and we started to bounce back in May. So we're still in the secondary trend, you could argue now, moving back up. Okay, but we need to get back over those the primary, or get back to the primary trend line to apply this. Okay. And again, I didn't mention about timeframes, did I? If you're wanting to apply some rules to Dow Theory as well, for the shorter timeframes, you know, come to my the webinars, the multiple time frame analysis webinar. I'll talk about that as well. Abbasi, I'll send it to you. Okay, we'll send you the PDF. Don't worry, everybody's very keen for the PDF. I'll do that after we've finished, and the recording will be up soon. Okay, so Abbasi, don't worry about getting the PDF. Okay, is that who was asking about this? Very good. So that's the secondary trend, and that was the minor trend. So let's just. Where was I? Yeah, so we were talking about live now. Yeah, so join me next week for the best book ever written on trading. I've got it here. I've got a big hard copy of it. Reminiscences of a Stock Operator by Edwin Lever, the story of the legendary Jesse Livermore. And then to finish the month, we've got volume price analysis, a great little oscillator for intraday traders. So if you're an intraday trader, come and watch Otto demonstrate the VWAP, volume price analysis, where prices should be and where they may go to. Great little indicator. As we do June, I'm going to put together, I've got a host of sort of very, very simple swing trading strategies. I'm going to do 2 webinars on very simple indicators that create a little catalog, a little portfolio of swing trading strategies. So the first one is on the 2nd of June. Swing trading strategies 1, and then the 16th of June, swing trading strategies 2. So do come along to those. Very, very simple. And within that, between those, I'll be talking about multiple time frame analysis. So using the time frames that work as well. So just going back to Dow Theory and drilling down to the lower time frames, you know, if you're going to use if you're a day trader, you want to be going back about 4, 5, 6 weeks, something like that, to give you sort of 26 sort of days to trade with. You know, a weekly trader, you want to be going back 6 months, so you get 26, 26 weeks, again 26 candles, and again the monthly trader, 2-3 years gives you 20-30 candles. If you're going back 3 years, 2 years gives you 24, obviously. So make sure the numbers are correlating to one another, the amount of time frames you're looking back and applying your multiple time frame analysis. But more on that actually in the session itself, and then drilling down into lower time frames. So swing trading strategies, divergence with Andrea, Fibonacci, which we touched on today, great technique. I loved Fibonacci with Otto on the 4th. Live analysis with Andrea, support and resistance with Otto on the 11th, Part 2 of swing trading on the 16th. The MACD and indicator, great little indicator, very, very powerful. Again, lots of many big traders, professional traders like the MACD, use the MACD all the time. Certainly. Stochastics, another oscillator, but perhaps less used very, very widely, perhaps equally as MACD. I don't know. We'd argue with that. Andrea, we touched on wave analysis today, didn't we? Briefly. Elliott wave analysis, probably the most famous. Andrea will start that at the end of June, do one in June and one in July. So Elliott wave part 1 with Andrea on the 23rd. Heikin-Ashi, different type of candle, but great for scalping, great for clarity, simple. I love the Heikin-Ashi candles. Price action and mean reversion. And finally, we'll finish the month with another live analysis webinar just on the markets with me on the 30th of June. So take care, everyone. Those of you that asked for the PDF, you will get it. I'll do it now after our session today. And thank you very much for attending. Any final questions from anybody? The video will be available to you all once it's uploaded. The marketing guy, you'll get an email later on today. Hopefully later on today if it's uploaded. It's taken a bit of a while now. And the PDF, those that want the PDF, you'll get that as well in email. If not, email us webinars@hotforex.com if you don't get it in the next day or two. Okay. Uma, is there any webinar based on the M and W pattern? I don't know if there is actually. That's a good question. We've done some. Yeah, we have done. Yeah, let me find. Again, Umar, I'll send you the link to it. Yes, we've got. That's harmonic price patterns as well. That's on there as well. Finally, what is the difference between SMA and EMA? Which one is perfect? Nothing, Umar, my friend. If anybody's told you that something is perfect, perfection doesn't exist, okay? Simple moving average and exponential moving average. I prefer the EMA, the exponential moving average, to the shorter time frames, but on a daily time frame and above, the difference between the two is negligible. Simple moving averages are the ones that most people understand. Simple moving averages are exactly that. So they'll take the period that they're looking at and give equal weighting to each of the periods. So for instance, a 20-day simple moving average will add up the prices of the 20 days, divide it by 20 and give you an average price for the 20 days. So that's a simple average. The exponential moving average for a 20-day period gives an extra weighting to the last few. So instead of day 1 and day 20 getting the same level of influence, the last few days of the period you're looking at, the last has more influence. That's all it is really. And there's lots of other types of moving averages, but the extra information you get from them is questionable, I would say. But anyway, use what works for you, my friend. Okay, so that's the difference between SMA and EMA. So thank you for your time, everyone. Do use our app. 3 of my favorite trading books of all time. One you can win, one we did a webinar on last month. And finally, that's where our written analysis is on the webinar page. Our email is here, webinars@hotforex.com. Those of you that have asked for the PDF will get the PDF. Follow me on Facebook and follow us on Twitter as well. We're obviously on Instagram and all other social media platforms as well. So take care, everyone. All the best, and we'll see you all again tomorrow and next week. Take care. Bye-bye.